During the most recent Q2 earnings season, technology hyperscalers posted historic revenue beats. Yet, instead of rewarding them, the market violently sold off their stock. Investors realized that the transition to artificial intelligence requires physical infrastructure construction on a scale we haven't seen in decades. Companies like Alphabet and Tesla presented CapEx projections so aggressive, they pushed free cash flow deep into the negative. The required spending spooked the markets. Traders are treating this trillion-dollar infrastructure supercycle as a structurally inflationary force, one that guarantees the Federal Reserve will have to keep the neutral rate higher for much longer. But reacting to the short-term capital burn of the training phase misses the macroeconomic endgame entirely. We are caught in a timeline contradiction. The immediate future requires a severe liquidity squeeze to build the infrastructure, but the ultimate output of that infrastructure is structural deflation. Right now, market models place the Fed's neutral rate in mildly accommodative territory, sitting between 4.0 and 4.25%. That rate environment is applying relentless upward pressure on the 30-year Treasury yield, forcing borrowing costs higher across the economy. This happens because the training phase of AI acts as a black hole for capital. It requires hundreds of billions of dollars in hardware, energy, and land before it yields widespread economic utility. The transition to the inference phase, where trained models move into production, marks the beginning of a rapid aggregate supply shock across the global economy. The current period of capital starvation precedes a systemic deflationary cycle that shifts the focus from how we fund the build-out to how policy models manage a resulting drop in prices. The global pool of capital is a finite resource, and due to multipolar geopolitical fracturing, the growth of that pool is experiencing a structural slowdown. The trailing 10-year growth rate of global savings has dropped to just 55%, sitting aggressively below historical averages. Drawing from this shrinking pool is the U.S. Treasury Department, which needs to capitalize massive deficit spending and roll over existing debt at higher rates. Entering the exact same debt markets are the tech hyperscalers, demanding between $800 billion and $1.2 trillion in CapEx over the next 2 years. Historically, international surplus economies recycle their dollars back into U.S. assets. Now, those foreign reserves are struggling to finance both the massive AI build-out and the U.S. government deficit at the same time. This private-public competition for scarce global capital forces the ex-ante cost of capital structurally higher for every participant in the market. Eventually, the financial cost of building the infrastructure matters less than the physical, cognitive output the infrastructure generates. The technology industry is already pivoting away from merely training closed models, shifting resources toward running millions of concurrent AI agents that execute complex tasks. Supporting that pivot requires an enormous hardware footprint, driving projections for the AI accelerator market to $1.4 trillion by 2030. Corporate leaders across the hardware ecosystem are already providing forward guidance that confirms this massive spike in inference demand. Inference is simply the mass deployment of intelligence as a widely accessible service, available to any business with an internet connection. AI transitions from a proprietary, closely guarded R&D expense into a globally accessible utility, laying the groundwork for a nearly infinite supply of cognitive labor. To model this, we track a professional services company's ratio of human labor to billable output. When it adopts AI tools, output jumps drastically. It completes 30% more work with zero increase in headcount or overhead, causing profit margins to widen. Investors often assume this margin expansion is permanent. In a free market, it is strictly temporary. AI models are rented utilities, so the barrier to entry drops to zero. Dozens of competitors integrate the same tools, producing identical high-margin output. To maintain market share, firms slash prices. Profit margins collapse while output remains elevated. Because the underlying technology is available to everyone instantly, this structural saturation will hit the broader economy at record speed. The productivity boom eventually translates into a permanent, structural collapse in consumer pricing across all cognitive sectors. This aggregate supply and demand graph maps that firm-level price collapse onto the macroeconomic scale. Here is our current economic equilibrium. As the AI inference phase scales, the aggregate supply curve shifts violently to the right. Real GDP surges upward. Because supply increases rapidly, prices plummet. This creates a severe divergence. Nominal GDP drops heavily, even as real GDP grows. This condition is a systemic, technology-driven deflationary spiral. When nominal GDP and real GDP decouple like this, the math underlying modern sovereign finance completely breaks down. The United States government faces a fatal vulnerability. Tax revenues are calculated as a percentage of nominal GDP, not real GDP. If prices fall, nominal tax receipts collapse. Those shrinking revenues must somehow service a $30 trillion national debt that continues to compound at high interest rates. This fiscal nightmare falls directly onto the Federal Reserve. The government simply cannot afford to roll over record debt at a fourth. This creates unstoppable institutional pressure on the bond market. To survive, the central bank will have to abandon its inflation targets entirely and pivot to aggressively fighting AI-driven deflation. To prevent a sovereign debt collapse, the Federal Reserve must become the buyer of last resort. Before 2030, they will be forced to crush the long end of the curve, returning the system to zero interest rates and total yield curve control.